Let's talk about protecting stock strategies. Just covered some married put ideas, but this comes in from Mike H. Now, I've had a conversation, conversations with Mike H, coaching sessions. He's a Power Options subscriber, Blueprint owner. He also follows Options Animal, Fidelity and Schwab, the new Fidelity Education Room as well, I think he said, and a couple of others. And I believe it's at Options Animal where they have a gentleman, very wise gentleman, very experienced trader, very good educator, great educator, I should say, who does in the money covered calls. They have another great educator, another great trader who really touts long collar positions. And then you have us over here, which show the picks of the day for the monthly and weekly covered calls at Power Options. And you have the married put approach as well. Mike is having this concern about if I'm using or I'm looking at an in the money covered call, does that make married puts moot? In fluctuating markets, and this is very similar to what Mark is asking at a crossroads of, hey, should I be doing married puts? Should I be doing covered calls? Should I just be buying and holding with these stocks I never plan on selling anyway and just let them go? In fluctuating markets, we wonder always, what is the best play? Are we keeping with a proven approach and adjusting? Are we moving to new strategies with the new market movements, trying to go back and forth, kind of yo-yo trading? And on that line too is, hey, I'm trying to make the best profit, but I'm trying to mitigate the losses. And these uncertain markets, news-driven markets, any moment a new announcement could be made, a new truth, I guess now, or X post could be made, and we see the market go into a little bit of a turmoil. So what is the best hedge for my portfolio, short-term or long-term? Following the trends just to add hedges when necessary, just rolling or adjusting as we go, thinking the market, hoping the market's going to come back to where it was, playing proven strategies for income with a hedge, or playing it safe to control risk at all times. Similar to what I decided with Mark, these are kind of questions I'm going to walk through on what I do. But these are the questions you want to answer for yourself for what time you want to commit to your trading. You can commit to your trading. And what are you looking for as far as your goals, risk control, and more? But what are low risk option strategies? Well, we talk about covered call positions, okay? Buying a stock. And the safest, we have other webinars on this that you can take a look at. What is the right strike price for a covered call? Why use in the money covered calls? Well, I'm going to buy a stock and sell an in the money covered call. I'm going to have a capped gain, but I'm going to have what Mike was looking for, a high downside protection. In this case, it means how far can the stock drop before I'm technically losing money on the position. I'm collecting intrinsic value with the in the money call, and I'm getting time premium as well. Not as much as, say, with an at-the-money covered calls, we know from the ATM bell curve from previous discussions we've had. But I get a good downside protection. I have a high probability of getting assigned, meaning the stock will stay above the strike price. I'll deliver my shares of stock for a 2 or 3% return, and then go on to the next trade, or maybe rebuy the stock. It's not meant for longer-term holds. It's a shorter-term play. Monthly, 1 week out, 2 weeks out, we were hoping to get assigned, hit singles, but have downside protection. Out of the money cash secured puts, I don't do anything with the stock. I sell an out of the money put, which enters me into an obligation to buy shares of stock at that lower price. The stock's trading below that at expiration if I don't roll or adjust. We have a capped gain. We have a high downside protection, but in the naked put, cash secured put, we call it the percent to break even. How far can the stock fall before I'm losing money in the position? Meaning it has to go below the put strike price and then the extra time premium. Because it's out of the money, all I collected was time premium. There's no intrinsic. But that premium is still in my account, so the break even is the strike price of my put minus the premium I collected. That's the percent to break even. High probability of expiring worthless, but if it doesn't and it falls, I potentially get to own shares of stock at a lower price. These are what we'd consider low risk option strategies because I have downside protection and I have a high probability of getting assigned and earning the return with the in-the-money covered call. Now, proven low-risk strategies. A lot of covered call investors have lost money over the years, right? Some people make it, some people don't. A lot of reasons why some people don't make consistent returns with covered calls is they think the market's always going to go up. So I'm going to buy stock at $75. I'm going to sell the 80 call. And if it moves up, I get an extra 5 points of unrealized gain plus the premium. And I can just keep repeating that over and over. But you have less downside protection. And in fluctuating markets, you see larger losses. You keep trying to roll down, then bam, you might even get locked into a loss if the stock moves up. Okay. Now, long collar positions. What are proven low risk strategies? Standard collar is what we're talking about in this approach. And what I mean by standard collar is I'm going to buy stock. I'm going to sell an at or out of the money call, which I mentioned normally wouldn't do, but I'm going to take that premium, some of that premium, and I'm going to buy an out of the money put with the same expiration date. I have a capped upside, so if the stock moves up, I get assigned, make my 2 or 3%, maybe 1.5%, 2% on the collar, and my put expires worthless. But I have a guaranteed capped downside better than a stop order. If the stock collapses and falls below my put strike price, I can only lose 2, 3, or 4%. Standard collar approach, this long collar approach is commonly done short term as well. 2 weeks out, 3 weeks out, 1 month out. Now the married put position. As you know, we buy a stock. We buy a put option only. Adds to the cost basis, as Mark mentioned in the previous discussion, and Mike is kind of concerned about now too. We have a guaranteed cap downside better than a stop order. The stock could fall 50% overnight, and I'm still guaranteed to get back that put strike price, only losing 5 or 6% on my position. Unlimited upside in the case of fluctuating markets in the upside or good strong markets that we've seen mostly since mid-April with a couple of hiccups that we had. And as I mentioned, you can use the put as a second asset. Now, that's talking about if we're using a radioactive trading approach in that sense, which we're going to talk about in a moment. Otherwise, from what Mike had asked recently, an out-of-the-money put doesn't allow you to work it as a second asset. Let's explain this. And Sean, I didn't read your question here fully, but we're going to get to your question, Sean, but I think you might have asked something similar to this. Wait, aren't spreads low risk position? Mike, you said low risk positions, covered calls, and out of the money cash secured puts proven long collars and married put approaches. But spread trades are low risk. What about credit spreads, debit spreads, condors, butterflies? What about buying calls, buying puts, or ratio back spreads? I can't lose more than what I just paid into the position. So why is that not low risk? Well, spread trades and leverage trades such as buying calls and buying puts are known risk. You know the risk going in, I agree. I know the maximum risk on my bull put credit spreads. I know the maximum risk on Ernie's long calls that he's buying following the Bollinger Band breakout default on the power option screen. But it's only a low risk position if you apply proper position sizing and discipline. This is why also most investors lose at the start when they start trading options, because they go for the home run hits. They expose themselves too much. And again, this is why you've heard me say that in my portfolio, yes, I trade bull put credit spreads. It's only 12 to 15% of my total portfolio. The reason why is that every 18 months or so, some event comes up that you can't control. And I'll have 3 or 4 bull put credit spreads open, most that were near, say, a 50% profit with only 5 or 7 days to go. The Black Swan event comes out. All 4 of those positions are down 50%. That's only a 7.5 or 6% hit to my total portfolio. The bull put credit spreads have been very profitable for me, but if I was doing it with 25%, I was doing it with 50% of my portfolio, I wouldn't have recovered from those declines. Proper position sizing, discipline. That's why I personally say, and anyone can disagree with me all you want, and that's fine because we're going to have different opinions about this. But unless you're disciplined, credit spreads, debit spreads, condors, butterflies are only low risk with proper position sizing and discipline. They're known risk trades, but they're not low risk unless you apply the proper position sizing. All right. But let's get to Mike's real question, and then let's dive into some thoughts. A common concern that we've been talking about here, hey, how do I get the best hedge? How do I get the best protection? Brought to light from recent coaching sessions. Looking at the protection from an out-of-the-money put versus an in-the-money covered call that has the downside protection. Is the in-the-money covered call with downside protection a way to obviate the need for puts? And Mike's talking about, hey, I don't want to pay for the puts. Similar as Mark was talking about, am I doing the right thing by paying for these puts? Fred commented in a moment ago on our discussion we wrapped up for Mark. He says, Mark can always sell monthly calls to pay for the put. That's what I do. Following one of the income methods in the blueprint, you've already heard me talk about that. My concern is that Mike is asking a question saying, hey, as Mark was, maybe I don't want to keep putting money into these puts. The way that Mike phrased it, though, he's looking at something different. I think he's comparing apples to pumpkins in this case. The in-the-money covered call. Buy the stock, sell a call below the strike price. What do we get? Good downside protection. Potential for a good return. A high probability of getting that return, a low probability of loss, in the sense that we need the stock to fall maybe 6, 7, 8% before we're at break even. There is the potential for a large loss, though. There's a 15 to 20% decline. Not expected, but if that happens, the AI bubble just burst. It's not going to, don't worry. But I'm saying if the AI bubble just burst, there's something that you were in. We saw some flux. Gold took a huge hit this week, right? It was on a tear. My AGS position was doing great in the Fusion portfolio, AGI position, in the Fusion portfolio. And then it wasn't. Bulletproof position dropped from 37 down to $30.80 per share, still guaranteed to make 3% on that trade. All right. Also, the in-the-money covered call, you're not looking to hold the position long term. You have a high probability of being assigned and getting your 2, 3, or 4% return. That's great. And you can buy the stock back next, but it might be at a higher price on Monday following the Friday expiration if you let it get assigned. You're not looking to hold the position and continue to manage it. You're just looking to get assigned, get return, find new trades. Manage if needs be. You can roll it up, but if you are doing it in the money covered call, just assume that you want the stock to be assigned and move on. And you could repeat. The out of the money married put. Buying a stock, buying a put below the strike price. Controlled risk, better than a stop order. You can't lose more than maybe 5, 6%. That's an out of the money married put. Sometimes it might be as high as 10, 12%. Potential for upside return because you have unlimited upside profit potential. You're looking for growth while controlling risk. You've got a medium probability of loss, meaning if the stock stays the same or moves down, you're going to have a small loss, but the maximum loss, you probably got a 30, 40% probability of seeing the maximum loss of that 5 or 6%. Not looking also to hold the stock long term. What do I mean by that? With an out of the money married put, it's mostly done 20 to 30 days out in time. You're trying to protect it from a fear of something coming up in the market on a shorter term trade. Not a radioactive trading approach with an out of the money married put. Well, what does it give us? We protect positions, we leave upside open, manage, repeat. Do I keep buying puts every 14 days, every 30 days? Yeah, well, we'll talk about that later. No, you won't, but we'll talk about that in a little bit. Right now, the out of the money married put is not what we advocate. What we advocate, and Mike might be asking out, but he's been asking questions about the long collars, combining the covered call with an out of the money put. If I was doing an in the money covered call, would I still use the out of the money put? The radioactive trading approach we advocate is for longer term growth on the stock. We're going to buy a stock, buy an in the money put, still have unlimited upside, but we're going to be 200 to 300 days out in time, as Mark mentioned. And as Fred just mentioned, one of the income methods I could use, income method number 1, is selling calls against that position short term, 14 days out, 20 days out, monthly calls, as Fred mentioned, to lower the cost basis, to pay for that put option using shorter term. All right. Okay, so yeah, Sean, I see your questions. They're probably prevalent to come in here, but we're going to go through that as well. And I just kind of answered that a moment ago. We'll come back to that slide. All right, I'm putting markers in this for myself as I'm talking. All right, now, like I said, what is Mike thinking? He could be comparing the benefits of the in-the-money covered call, high downside protection, high probability of being assigned and getting that 1.5 to 2.5, 3% return. Benefits of an in-the-money call with an out-of-the-money put, I wouldn't do. It's a long collar position, but again, as I mentioned, the long collar approach is commonly buying the stock, selling an at or out-of-the-money call, then buying an out-of-the-money put to still keep a proper premium and have a floor. Okay. Benefits of an out-of-the-money married put, yeah, well, we talked about that. But if you're looking for longer-term growth and being in the position longer-term, that's when I'm using the radioactive trading structure, the proper married put. All right, opening a stock. What is the best hedge? Mike, again, asked this question at the survey. It was a comment. There are 3 questions that come up at the end of the webinar. Hey, rate Mike's presentation. Did he cover things well? You know, was he okay? Was he clear? Was he concise? A rating of 1 to 5. Do you have any thoughts or comments on the topics discussed today, and what topic would you like to see discussed? And this was Mike's comment that he mentioned. If I'm looking at in-the-money covered calls, does it make the addition of a long put useless? Do I not need it? All right. The 21st, Tuesday of this week, just took one that came up on the married put search, actually. It was a firm. It was trading at 74.50. These were closing prices. Okay. Now, an in-the-money covered call, stocks at 74.50. I could sell the October 31st 72 call, happy Halloween to me, for $5. This lowers my cost basis down to 69.50. My max profit, if assigned at $72 per share, is going to be $250. It's a 6.7% downside protection. I lowered my cost basis down to $69.50. So I have a downside protection of 6.7%. Can't lose unless the stock drops below $69.50. This returns about 3.6% if I'm not mistaken, and it has a 60.1% probability of being assigned. I'm not expecting a firm to go bankrupt, but keep in mind, on the covered call trade, even with a stop order in place or a trailing stop, you are risking 100% of that $69.50 per share that you have in this trade. If the stock goes to zero, the stock goes to $1 for whatever reason, your downside protection can help you. Is it going to? No. Am I expecting it to? Absolutely not. I've got a good 61 chance theoretical probability of making this 3.5, 3.6% return, having about a 7% downside protection for the next 14, 15 days. Beautiful. Same strike, out of the money married put. If I did the out of the money cash secured put, it'd be a parity trade, but we're talking about buying it, the married put. Firm at 74.50. The October 31st 72 strike put was at 235. Now my cost basis goes up to 76.85. I'm guaranteed an exit of $72, that floor, no matter what happens. I have unlimited upside profit potential, but the maximum risk for my cost basis of 76.85, the 72 strike, is 485 or 6.3%. But it's anywhere below $72 per share. I can only lose 6.3%. It could drop to 60, it could drop to 50, it could drop to 40. I'm guaranteed to only lose 6.3%. But again, I'm not going to sugarcoat it. For 14 days, I increased my cost basis up to 76.85. So I need the stock in 14 days to be above 76.85 before I make a profit on this position. The out of the money short-term married put as a short-term hedge. Pros and cons. What did we talk about? Here's the affirm covered call. See a 3.6% potential return if assigned. And again, it was that 60.1% theoretical probability assigned. Good downside protection. We don't lose money until the stock drops to 69.50. As you can see today, it's up at 75.75 at the close. Potential for a good return. All it has to do is stay above 72. I make 3.6%. 60% probability. Relatively low probability of loss. I think when I looked the 70 strike or the 69 strike, if the theoretical probability of the stock would be below 69 or below 70 near our break even, at that point was only around 28%. It had 72, 75% probability above, so 25, 22% below. I'm not looking to hold the stock long term. If I get assigned, if it stays anywhere above 72, I'm just going to let it get assigned. Would I roll it? Well, if I was looking to hold this long term and roll it, I wouldn't have sold an in the money covered call. I would have sold an out of the money covered call, hoping to get some appreciation. You get returns. I get assigned on a firm, my 2 other covered calls, log into Power Options Monday morning after the cash clears out of my account, run the monthly picks of the day, weekly picks of the day trades again, find new in the money covered calls to continue hitting these singles. The out of the money married put, buying the stock at 74.50 the same day, buying the 31st of October 72 strike put at 235, increase my cost basis, my break even up to 76.85. Low probability there. I'm not lying. It's a low probability the stock's going to be above 76.85. It was probably about 38%, 39%, I think, when I looked. But if the stock falls, I can't lose more than 6.3% on the position. I'm looking for movement to the upside. Hey, out of the money married put here, stock that I've owned for a while. Why would I do this and when would I do this? Maybe coming up to earnings, something along those lines. Maybe looking at something at that. But again, in this case, the out of the money married put is a wasting asset. Out of the money put buying on a stock with selling a call that's at or out of the money is a standard collar position, which I do advocate. Risk of only 2 or 3, maybe 4%, potential return of 1.5 to 3%. Okay. Now, let's move on. Combine the two. And this was what Mike kind of mentioned. And I showed it this way. He says, we combine the two. Does it make the idea for an out of the money put obsolete if I'm doing in the money covered calls? My answer to you is yes. If I chose to do an in the money covered call, Mike, it's because I'm going for this trading plan. Having a good downside protection, high potential return if assigned, getting that return, moving on, not being locked into the stock long term. I'm looking to be assigned. It's as simple as that, in my opinion. I'm not going to sell an in the money covered call and get $1 worth of time premium with the whole plan that I'm just going to keep rolling it in the money. That's too much cost. That's too much effort. I'm going to let it be assigned. I'm going to look for new positions. The put gives us a base, but if you combine the two, if I sold that 72 strike call that I mentioned, and at the same time bought the 72 put, this is a different type of collar. This is a conversion. At the prices we saw in the close on Tuesday, it's a straight line profit and loss chart. I get $5 for the 72 strike call that we saw. I pay $2.35 for the October 31st put that we were discussing as well. And so I still have a positive premium in this case of roughly $2.65. It lowers my cost basis down to $71.85. Why is it a straight line profit and loss chart? Because if the stock is above 72, we get assigned and make our $15. If it falls below 72, going to zero even, the call expires, we exercise our put, and we make $15, 0.2%. The conversion, usually you have to go a month or 2 months or 3 months out in time, get the right bid-ask spreads and the right activity to find a position that gives you a reasonable return for the time frame. But this is likely not what Mike was talking about, saying, hey, if I sold the 72 strike call on a firm at 74.50, would I still buy a 70 strike put out of the money? In my opinion, no. Opening a firm at 74.50, I likely would have sold a 75, 76 strike call and probably bought the 72, maybe the 73 put to have that standard collar position, making about 1.5% to the upside if assigned, hopefully at 75 or so, which we're doing good right now. And if it fell below that 73 strike, I'm probably only risking about 3%. Controlled risk, guaranteed. Potential for return, but lower probability. But if I'm chosen to do an in-the-money covered call, I'm not using a put option. Now, again, I use that term. It is the season, but an apples to pumpkins sort of comparison. I'm doing a covered call. I get good downside protection in the money covered call. I get good downside protection. I have the potential of making 3.6% on the firm in the next 7 to 8 days. And when we opened it, it was, 11, 10 days. And I've got that 6.7% downside protection. The stock has to fall 7% before I'm losing money on the position. Out of the money married put approach, I paid more cost basis to the position, but I left the upside open. I'm looking more for growth and a little bit more of hope, but I'm controlling risk. Again, this is not what we advocate at all when we talk about married put positions. I would use this in a short-term standard collar position to control risk. I might use it on a stock that I own coming up to earnings just to be a hedge in case there's something so unexpected that it throws me off. But if I've chosen to do an in-the-money covered call, and that's going to be my trading plan and approach, high probability, good percentage return. I might even, honestly, with a firm, I probably would have gone with a higher probability, closer to 70 or 75 for maybe only a 1.8% return or 1.5% return in 10, 14 days. Higher probability in that case, and I would have had a higher downside protection, but less return. We've talked about that in many webinars when we've gone ahead and discussed, what is the proper strike price for a covered call position. This is not the preferred approach that we do. And no, if I'm doing an in-the-money covered call, Mike, I don't see the need for any type of put protection.